Hello, everyone. Welcome back. Welcome back to the Visionary Pulse podcast. This is a podcast where we're going to be talking about all things business, personal finance, and all the relevant news that are going to be impacting you on a day-to-day. I am your host, Abdi, and thank you for joining me. First of all, I would like to address the bajillion people who told me, hey, where's the video, my man? Here's the video, okay? I went out and bought a $1,000 camera, the Canon M50. Holla at your boy for privates. I'm now an expert in all things camera. And I did not think I was going to get this many people requesting that I see my face. This is definitely a first. So I'm glad I'm glad that people are requesting such things. But here it is. We've now upgraded. So now we're doing a video podcast. So thank you for joining me again. Secondly, I would like to talk about the rest of the feedback that I received, which has taken my breath away, because a lot of people have given me such kind words towards my efforts that I've done on the last podcast, and I did not expect to receive such positive feedback. I literally expected my inbox filled with people and their opinions, which I really expected, and I still welcome, because like I said, I probably am still making 1,000 mistakes a minute, so there's still room for improvement. There's always room for improvement. So as usual, comment down below, let me know what you think I can do better, and I would love to improve. I also am very open to different topics of discussions that you would like me to attempt and give you my 2 cents on. So if there's something that you're really interested in and want me to do a deep dive in a particular topic, I welcome all ideas and all suggestions. I also have spoken to one of my friends who is some kind of a NFT/crypto connoisseur. And I was wondering if my audience would love to hear like an intro to crypto/NFTs. Honestly, I know a little bit about crypto and NFTs. I am not 100%. So what I'm going to be bringing you is really just a simple explanations. Like, I'm not endorsing it whatsoever, as I'm not endorsing anything on this podcast. I am just giving you my thoughts, and as usual, not financial advice. So don't take my advice. I am just a dude on the internet, so do as you will. So yeah, welcome back. Stock finance. First, interest. People's favorite topics. Interest rates have been raised again by the bank, and they're planning to increase it even more. And one thing that you need to know about planned increases in interest rates is that once the market, and by market I mean the stock market, once they hear that there's an interest rate increase, they immediately go into a spiral. As soon as they hear there might be an increase, they assume the worst, the end of the world. And then whenever the rate increases and nothing dies, then they're like, okay, let's go back in. But yeah, the market has, if you have anything invested right now, you might see that your portfolio is very red. Very, very red, including mine. I don't think anyone is green right now, so that's just part of life. Now, what I wanted to talk about interest rates and how it might impact you in your life. The first thing I wanted to talk about is the impact on housing. Now, we have seen housing prices kind of drop a little bit, and I don't think, like, a lot of people, they think that interest rates are going up, so house is going to go down, and it's going to go down to like pre-pandemic levels. No, I don't think that's going to be a thing. I think that it's going to correct itself, probably, like, because how much it increased from 2020 to now is outrageous. So there's definitely going to be a little bit of pullback towards that front. But I also wanted to give you another perspective, which is there was a interview from the preliminary conservative. I think he's not the conservative leader, but he's one of the prominent conservatives. Not that I endorse any political parties, but he was grilling the Canadian Housing and Insurance Commission, CMHC, something like that. And he was asking them about what's the percentage of Canadians who purchased a house at 5% down, and as much and how many Canadians have purchased a house with a variable rate. Now, why is that important? Number one, for the 5% down, the thing about buying a house is it's an asset. So if you can't afford it, for example, like you're like, okay, let's buy a house. Okay, now that I can't afford it, let's sell it. Just pocket the difference of the sale price and how much I owe to the bank, and then let's just go back to renting. And you're still better off than not buying a house if you held it for any significant amount of time. Now, if the person that is selling has 5% and they've purchased in the last 2 years, there is a very likely chance that if they sell their house, they're going to lose money on the sale. So what does that mean? If you can't cover the whole mortgage with the sale price, and don't forget the 5% that the lovely real estate agents take, then you're going to be owing money to the bank. And that's not the kind of money that is easy to pay back. It's like if it drops 50K and you owe them 50K, that's a big no. So that's kind of like what we would consider negative equity into the house, because if you sell the house and you pay after you pay off all the expenses, how much do you have in your pocket? And if it's positive, then it's positive equity, and if it's negative, that's negative equity. So it's very, very, very not good to have negative equity, but it's especially not good if you can't afford the house in which you have to sell, because you either sell the house or go bankrupt, and both of those are not positive or nice outcomes of a situation. So yeah, there's a pretty big portion of Canadians who have that scenario. Not that they can't afford their house and they need to sell, but they're likely going to be with these drop in prices. They're likely to be in the territory of negative equity. But again, that's not the end of the world unless they can't pay for their mortgage, which is going to bring me to my second point, the variable mortgages. If anyone has a variable mortgage, they've noticed that their payments have increased a few months in a row. So if you can't afford those payments anymore, then not only are you just getting more and more, it's costing you more and more every month to pay for your housing, but also you can't sell the house because you're going to lose the value of your investment. So those people are kind of getting hammered right now. And the thing about having all these issues come on at once is I'm not sure if the Canadian government is aware of this or if it's a intended side effect. What that's going to do in a not so good scenario is the people who are in that scenario are going to be pushed out of their house. What's that going to mean? There's going to be an increase of inventory in the housing, but not in a nice way, in the foreclosure way. Like back in 2008, you're going to have a bunch of houses that cannot be sold, cannot be kept by the owners, so that the bank foreclosed on, or they were sold at a loss, and then the people who got wrecked in this move are basically homeless or have gotten into a situation where they're about to go bankrupt, which is not a enviable position, which kind of is helping the goal of increasing the inventory of the housing market, because it is one of the biggest factor is that there's such little inventory of houses being sold on a month-to-month basis. So usually, this is actually a comment I was talking to my mom about. How does the economy work in a functioning country? There's a hammer, and the hammer hits the economy. The goal of the hammer is to equal things out. Usually, the hammer hits the people who are wealthy and helps the people who are not as wealthy. This move is not that. Like, it does not help the low-income people, and the high-income people is kind of like an unwanted nuisance. So it's not good. Having more inventory into the market is good, but I do not want it to be done at the expense of having a lot of people go bankrupt. That is not good for us as a society, and it's not good for businesses because you're going to lose customers because those people who are bankrupt, like obviously their purchasing power goes way down. And even as a human level, like that's not what you want to hear. So I am cautiously not optimistic about what's coming up, especially because they are planning on more rate hikes. And I don't know how much the Canadian public are going to be prepared for that. And yeah, so it's not good. Now, the interest rates have also affected the market, as I spoke about earlier. And what I think people are starting to understand is we are likely to head towards a recession. Although I've been saying we are in recession because you only know you're in a recession when you've been in a recession for 2 quarters. So let me tell you, we are in a recession. So usually when there's a recession, the stock market usually drops. And you might be like, hey, what do I care if the market drops? Like, you should care. If you have a pension, that pension is invested in the stock market. So whether you like it or not, this impacts you. So what does that mean? A recession. Well, I would like to tell you an analogy, or not an analogy, a story from one of my favorite YouTubers, Graham Stephan. And he was mentioning on how he started off his wealth is when the stock market and the housing market crashed in 2008. He just happened to have quite a bit of cash from working his real estate job. And he just decided to buy when everyone else was like, the world is ending. Let's sell everything. Let's not keep anything. Like, this is not safe. And he made a tremendous investment gain because he bought houses. I don't think that we're going to see stuff like that, but he bought houses at a ridiculously low price. Like, I don't know, I think one of them was $30,000. I was like, my God, a house for $30,000? That's like not even half of some of the people's down payment. So that's just so crazy. But what I'm trying to extrapolate from this story is, even when there's economic downturn, like now, there is possibility to make money. And usually, when people are selling, the smart people, I mean the wealthy people, some of them might not be so smart, but they are wealthy, they say buy when the people are selling because they follow trends, and the people who make money don't usually follow the trends. So, as well as I was talking to one of my good friends about crypto. He bought Bitcoin at a super low rate, and then we were just watching it just explode to 20,000, 30,000. You're like, oh my God, you made so much money. I wish I invested at that time. Well, I think that this is that time. This is that time where it's a smart idea to invest like now. Again, this is not financial advice, but this is what I'm going to be doing. However, I understand that there's a concern that what if I'm not timing it right? What if I am buying but the dip is still going? Like the market might still be dipping 30% from now until they like go back up. And the thing is, it's impossible to time when it's going to go up and when it's going to go down. Sometimes you have small windows of like, hey, I should probably buy now. But those windows are very few, and you have to be like a hawk watching the market all the time. And I don't think, even for people in the industry or industry adjacent like me, to time the market, like it's not feasible for everyone, for almost everyone. One of the things that is important about buying into the market is if you just miss the 10 best trading days, so just having the money into the market, you would have lost a significant amount of return in your strategy in a 30-year time frame. So just having your money into the market is a way better strategy for everyone, for almost everyone, rather than trying to time in the market. And as the old cliche said, time in the market beats timing the market. So just keep your time into the market, put your money into the market, and then watch it grow. I am also going to be giving you like the opposite side of it. What if the markets crash and like we lose all our money? I think if the market crashes and we lose all our money, the least of our concern is how much money we have into the stock market, because I think that would be the collapse of society as a whole, and money would literally be worthless even if you had it in your bank. So I don't think it's the smart play to keep holding money, thinking that you're kind of escaping that fate. I think that fate is yours, and there's no way to go around it. I do, however, have a counter argument, which I think is fair to say, hey, look, the markets might go down and these things might be worthless. You can always invest in things that have a value historically since the dawn of time. What are those things? Precious metals. You can buy gold, you can buy diamonds, you can buy whatever, and keep those. And even if society collapses, those things usually hold value. So if you want some sort of a nest egg in case you think that the world is ending, then it's probably a good idea to invest in. And you know what? Investing in gold and investing in diamonds and stuff like that, it's the return on that is not bad. So it's kind of a win-win situation. Gold typically keeps its value regardless of where the dollar is trading. It doesn't care if it goes up or down. Like it's one of those few things that is like a workhorse, just doesn't care. Like it just goes up and up and up and up. The returns are obviously not that great compared to some of the market returns, but it's by no means zero. So that might be something that you put. And also, this is another thing that you would have to keep in mind. Diversification of your investments is probably the number one thing that keeps you safe. Keeping your portfolio, I know like if you don't have that much money, it's hard to have a portfolio of different investments, but ideally you would have a little bit into real estate, a little bit into the stock market, a little bit into cash, and a little bit into other stuff like art, precious metals, precious rocks and metals, and those things usually keep their value. So if you take a strategy of investing like that, I think that would be very beneficial for you in the long term. And this actually brings me to my last point, which is investing into the stock market kind of rant that I feel like everyone who knows me has heard me yap my mouth about. The thing about investing in the market is you need two kind of different accounts. You need either a self-directed account or a managed account. And now, a managed account, what happens is you're paying for a financial firm to analyze the market and then give you purchasing portfolio. So they'll be like, hey, give us $1 bajillion, and we'll buy a percentage of gold. We'll buy some bonds. We'll buy some stocks, some index funds, and we'll pool them all together, and that should give you the best, well diversified portfolio for a fee, and they usually take about 2%. The problem with a 2% fee is that compounded over 30 years. Do you have any idea how much that is? So if you keep your money and you're perpetually investing into this mutual fund, that 2% is actually 50% of your profits. When you take a look at the return, like let's say even if they match the market, which is about 12-14%, just the fact that they're taking 2% is literally 50% of your, like, I know it says like, okay, look, I'm gonna make 12%, so if they take, I'm still making 10%. No. No. When you're looking at a exponential curve, which is what an investment curve is over 35 years, because most of the income that you're making is going to be towards the last 5 years. And in those last 5 years, they're literally taking 50% of that, of your investment, even if it's at a 2%. So what's the answer, Abdi? You're yapping your mouth all about how they're not good. What do I do? Well, let me tell you. Self-directed investment portfolios, in my opinion, are the best way to go, because it's super easy and you don't need any advice and you don't need anyone to tell you how to do it. Open any account that lets you buy and sell shares into the market. Now, what you do is do a Google search different index funds or ETFs. Index funds, they just have like a bigger, you just have to invest more money at once. So I think for like standard indexes that track the market, I think you have to have a minimum of 3,000. But you can also buy ETFs, which are condensed into a share like proportion. Like you could buy like a share of an index, a little bit more complicated, but let's say you can buy a share of pooled, so they have all kinds of different shares into that pool, and then they like divide it by X number of shares, and then they could just issue all of those. And then when you buy one share from them, it's like you're buying 100 different shares into the market, and that kind of diversifies all the different markets. You can buy like the S&P 500 was just the top 500 companies. You can buy the whole market, like they just buy the whole market, and then they just cut a slice off and give you one share that has a percentage of all those shares in the market. So whatever your strategy is, you want to invest in green, you want to invest in tech, you want to invest just the S&P 500, the TSX indicators, like all of that, they're usually all good. Like just look at their historical, see how they perform over 35 years, find a few that you like to invest in, and then just buy. And that's it. Just buy those, and that's it. I'm not even going to tell you which one to buy, because literally they're mostly all very good. One caveat I would tell you is try to look at their market cap. That's just how much money overall is worth into that pool of assets. Try to be above like $1 billion. Like some of them are very small, and if there's under $1 billion, you might be you might be subject to a lot of price fluctuation. So that might not be so good. So stick to the big ones, and you should be good. Those are tracking the market, and you pay literally 0.07%, and that does not impact your strategy as much. It's literally like a 1/50th of what the managed portfolios usually take. So there was actually a lot of topics that I wanted to talk about into this video, but I feel like most people are kind of concerned about the inflation that they're feeling right now, and the increase in interest rates, and how the markets are doing, and how gas is worth $2.15 a liter. What? Side note, that's terrible. Whoever's doing that, please stop. Please stop. I'm begging you. So I had a few different topics that I wanted to talk about, but I felt like those were might be the more relevant for people. To close out, I would like to share some optimism. After each period of hardship, there is usually a boom. A boom in increased value of shares, if that's what you're into, increased values of homes, increased value of wealth. So a lot of times in life, a win is just keeping your head above water. That's literally it. If you're surviving, literally that's victory. Like, you should not be worried about doing anything else than just surviving. Survive, and you have the best chance of succeeding, because victory looks differently on each day. Some days it looks like you're crushing it. You just ran a 40-mile run and made $1 bajillion. I know my denomination of dollars are very accurate. But some days you're like, I got out of bed. And that's it. That's all I got. And I survived, and we're good. So some days, like, we're heading around a downturn. So keep your heads up. Don't worry too much about the future. Try to survive one day at a time, and keep telling yourself that as you're going through this, you're winning. You're just winning just by literally living. You're winning by not giving up. Good luck to everyone. And I wish you all a fantastic week. And if you have any questions or any concerns, if you're a business owner and you need help with your taxes, please give me a shout. I would love to help. I know the deadline for corporate taxes is coming up. If you have any concerns, any questions, anything, I would love to help. I also cannot do a video next week, but a podcast. But I am planning something for next week. Hope you like it. I'm going to be back to the podcast next Monday. So not this Monday, the Monday after. So look forward to that. I am also very open to any comments. If you made it this far, please let me know. Give me a like, a comment, and dare I say, a subscribe. For more content like this, I hope you enjoyed, and I hope I see you again next time. So my name is Abdi. Thank you very much for joining me, and until next time.